Hey traders, Jeff Yates coming to you from Full Throttle Traders. I'm going to take a few minutes today and walk you through a step-by-step process that I use specifically, personally, when it comes to trading options, and how the title of this presentation you're about to see, it's very short, but it's titled How to Have Your Cake and Eat It Too. Now the market typically doesn't allow that. They don't allow us to say, can I take both sides of the market? And that's what we're really saying. We're talking about having our cake and eat it too. And normally that's the case, and it really still is the case, but there's some things that you can do that kind of put you in a better position, almost to kind of frame the outline of that comment to make it more real. We do that in our option strategies. Now, this is on August 7th, 2025. If you've been trading here in the last few months, really this year, market's very erratic, right? A lot of news, just a lot of things going on in the world, so the market's very reactional to those things. So whereas before we would trade maybe specific supply and demand areas, like we would follow that footprint of money, which is still the key to do, but you have to either give them more room or have some other internal managements that allows you to adapt to some of the erratic price moves, because ultimately those patterns work out, but in the short term they get very erratic. And if you're trying to use traditional type stops, you're probably having an issue these days. So I'm going to take a few minutes and walk you through a very generic way of how we use this strategy and how to have your cake and eat it too, to be able to put this in a better light on both sides of the market, whether it's going for us or against us. And again, for the full presentation, you can always email me, Jeff at Full Throttle Traders, or come check us out at Full Throttle Traders, and you'll have access to this presentation as well. A little bit longer, a little bit more in-depth one as well. So anyway, stay tuned. We'll get started right away. All right. So let's take a look here. And again, once again, the title, How to Have Your Cake and Eat It Too. This is more of an advanced option strategy for option swing traders and weekly income, while generating weekly income while controlling risk. So we use a little bit of naked call, puts, what have you. Then we add some diagonal spreads, or we add to the position, then we add some diagonals, and ultimately we go into a bull call spread. So we're using a variation of mechanics from an option standpoint to start off with the biggest gain, like the biggest opportunity that you have in an advancement in an option is not to have any, selling any options against it. So it's kind of a straight option or a naked option. But a lot of times that doesn't always work out. Now, I'm sure I'm speaking to a lot of other people out there. When you think to get in the option, you're never right about the entry, rarely right within 10%, 5%. So I expect it to draw back against me. So when I do that, I typically load about half my position in. Now I'm trading about $2,500 risk per option trade. So I'll kind of walk through the mechanics based on that material, and then you can adjust it if you trade $100 or $200 or even more. You can get the mechanics of how this works. This works well. It has a series. You can even roll options at the very end of this, so I'll kind of walk you through the basics. So let's take a look here. The core idea, obviously, is what does have your cake and eat it to mean? Trading it means we capture upside without control risk, right? With control risk, I'm sorry. So we're trying to capture the upside gain, but as we know, the market typically comes at us when you're dealing with 30 to 60-day options. There's going to be sometimes you get in that pullback. You're right about the long term. You're wrong about that 7, 10, 14-day process to gain the momentum that you want to the upside or downside if you're buying puts. Take profits along the way and redeploy. We'll talk about that, and also some of the mechanics that we use. We use 3 different strategies in our options play to help us navigate through the process. Now, also adapt to market movement instead of predicting it. So we're, the pattern might be there. We're trying to get the pullback for the entry, but at the same time, we're adapting to the movement. So as I told our traders today in our room, it's not that easy to get out and get into a price where the pattern looks good on the daily 65-minute chart and expect things to go up from there. It just doesn't happen. It never has, but it's having more of erratic moves these days than I've probably seen really ever. So after 25 years of doing this, so we'll talk about those adaptive moves. The goal of that is, of course, is to lower your cost basis, lower your average entry, and lower your cost basis using diagonals as an interim way to wait if we get the stock moving back in your favor. So step 1, strategic entry, DTE. Choose the closest to 45-day. Now, if you have a pattern let's say, we'll look at one here in Uber that we took today. You have a pattern. I'm typically looking out to the third week. I'm usually going, 35 to 50 days based on the next monthly option is, which is the third Friday of the week of the month. But anywhere closest to a 45-day or higher, except for large gaps. What do I mean by that? I also play a unique strategy only for stocks that have gapped down. I play a strategy where I'm looking for a lot bigger of a slingshot move because of the extension, and I use 60, probably to closer to 80-day out of the money options. But again, I won't go over that today. You can get that from me one-on-one if you like, or in our room. But I'm going to cover mainly the pattern, but I'm going to cover the strategy for all. Okay, so basically I have a $2,500 risk per trade. So let's say I had, let's see, will that be about a $600? Let's see, yeah, let's say I had a $6 option here I wanted to get into. I never go full, right? I go into a half position. So in that case, instead of going into 2,500, I might, instead of doing 4 options, I might do 2 contracts. So instead of 4 contracts, 2. So it's reducing my entry, expecting the pullback to gain a better cost average price. I only do this once. You never want a dollar cost average as a method or a tool or a strategy to better the options for a bounce. You're never going to be a good place like that usually. But as long as you have a strategy you can play out, like I do here, then it's not a bad thing. So half size at the money or slightly in the money calls, typically that's where a lot of the open interest and volume takes place, and you have a tighter spread. Lower expiration, cheaper option, and higher gamma. So again, lower expirations at 45 days helps us to kind of get a little bit more of a gamma run, and you're paying a little bit less for the options. Now, for me, I always factor what my overall risk is. I don't ever factor 2 contracts for a $90 stock or 3 or 1. I'm factoring what am I paying for the option, divide that by my risk, and that's what it is. Now, even though I'm dividing that by full loss risk, I'm never going to take a full loss. I'm just giving me a starting point how to get into and start getting into with contracts. I know my worst case if the company went bankrupt tomorrow, and I base it off that, but it's not, I'm going to be adding 2, so it's not going to be exactly where a 50% loss. I'm not factoring that. I'm factoring what would be happening with the 0. So if I had a $6 option and I was looking for a $1,200 entry on half, it's 2, right? I know at 50% it could be 4. I get it, but I'm not playing it that way. So you have to watch this strategy to kind of catch the gleam of that. So max risk for the leg, $1,250, based on a half of full lot risk. Today that actually happened just like that as I moved into. Okay, so I'll show you on Uber a little bit later. Max risk for this $1,250. So I enter in my position half, period, okay? Again, that's assuming the stock went to 0, and it's not, but it gives me a starting point to bring up calculation. Now again, this is my personal risk, and I've done as much as $10,000 a trade for options here, and certainly that's something you can do or graduate to once you feel comfortable. Anyway, based on half lot, let's move on. Step 2, we want to trade. We want to look for the strategy, or we want to look for, get this out of the way here, the open interest. So we're looking for, in this case Uber, typically the next monthly period that has the best open interest in here. That's kind of what I have here, right? Anyway, when you have a lot of open interest, you typically have a lot of volume. When you have that, you have a tight spread. And that's not always the case, right? Sometimes you have spotty volume, spotty open interest, and a lot of times your spread is $1 or $2. Even on small $5 could be $6.50. So you want to try to avoid that if at all possible. Here's an example of 40 days. As you can see, look at the open interest in here. See the spotty volume, but look at the spread. Same situation, just went in to the next expiration. You got a $1.05, $1.10 spread on the same strike on Uber. So you want to look for, going back, look for that open interest in here. Obviously take a tighter spread in here, and you want open interest to back you up in case you're wrong. You're not going to worry about trying to get out at 40, and next thing you know, you get out at 590. So this helps create a lot more levels and ladders to get in and out of. All right, so let's move on. So step 2, tier in on the pullback. Now, so if the option pulls back 20%, I add the second half of my position. So for example, this is based on 15%. I recently changed this to 20, but let's just assume that 425 was 20. It's actually $1. But let's say it pulled back to 425, right? That'd be my add point. So at that point, I'm full in that option. Now I have a net average price of 462. So at the end of the day, I'm about 8% better averaged into the position by taking that 15-20% pullback. Now I'm full, but it's going against me, which I kind of expect in this erratic market, as I mentioned at the forefront. So now what do? Well, now we're in, what do? We average cost basis recalculate at 462. The hedging starts now using the 462 as the new price. So what I start to do is at any point, I'm looking at, after averaging in, I'm looking to leg into a full lot of a diagonal spread. So if I was in 2 contracts, I want to start lowering my cost basis. One of the best ways to do that is using the diagonal spreads, which basically you're doing a, let's say an at the money call option, then you're going in on the strikes and then going further out of the money. And that means you get a faster burn, not only being out of the money, but you also put yourself in a better light because you're also closer to expiration. So it will burn many times faster than your at the money original call would burn. Now, one point, you're not fully covered on a diagonal. For the most part you are, but you're not fully covered. When you're fully covered, you basically have a bull call spread, same expiration, out of the money you're covered. So diagonals could be a little different, but for the most part you are. It's rare you have a situation, if you're not, you're covered most of it anyway. Sell a short call, 7 to 14 days at the 25-35 delta. Now, what do I mean by that? The goal is to lower cost basis. Now, if I'm out, let's say 45, 50 days, and I can find an average of a 10 delta, I can run probably 2 of these. Sometimes I can run as much as 4 when I'm going longer dated out to 70, 80 days, but I could probably run 2 at somewhere around probably 30 to 40 cents. So if I take a 40 cents sell the call against that, when the profit leg, the short leg reaches 70%, I'm coming out twice. So let's say I get out 70% twice on a 45-day average, so I got 10, 20, I'm at 25 days left in the expiration. I've lowered my cost basis by 60 cents. Using that same example, I got 425, I lower by 60, now my average cost is now 365, 370. So that's kind of where I am. And that's where this final step comes in here. So we start here, hedging with a diagonal. Third, start hedging with a diagonal. This is kind of what it looks like. When I'm out further in time, I can do 4 diagonals against it, right? I average in 40 cents, 40, and again, 70% of 40 is 28 cents, so it's 397, 369, 341, 313. So I took what originally was a $5 option, and what I paid for it, effectively I'm in a $3.13 option. So I've lowered my cost basis by over 27% at that point. So again, this is the division of those 2. Great way to cost for you. Now again, this is if you still believe in the pattern. Even if you don't believe in the pattern, a lot of times you can get that slingshot approach as long as you're not down in the abyss, out above the 50-period moving average or something like that. You can roll those options out as well if need be. I won't go that much into this, that's another subject, but it'll give you an idea. Things you can help fix bad trades later on. Finally, repeat the diagonal. If time allows, the goal is to complete the diagonal twice, right? So if time allows, is completed twice, that's on a 45-day expiration. But if you're going out 70 days, you can complete that 4 times. You can lower that down to probably 2 1/4 or so. So again, if more than 3 weeks out remaining before the long call, so 21 days, you want to close the first short call at 70% profit, sell a second 10 DT to 30 deltas, and once again, rinse and repeat. Maintain staggered income against the long. It just basically means that every time I do that, and again, if I'm wrong about that, that long is going to grow faster than the diagonal. You just don't want the diagonal to be too close to it. In case price gets here, you got to roll that diagonal out. Sometimes though, you have to roll the diagonal out and make sure you don't roll it into a losing position. A lot of people do that early on. Typically, what do I mean by that? If you have a 10 wide strike and you have a $5 difference on your premium between your diagonal and your call, that's good. You don't want any more than about 65% of that. So if I rolled it out to where I had an $8 premium or a $9 premium and I only was a 10 wide, that's 90%. You don't have a chance to win. So make sure when you do the spread, look at your new premium and say, is that less than 65, 70%? If it is, you might have something. If it goes higher than that, you're too wide. You need to shorten up because otherwise you've actually rolled yourself into a diagonal that is guaranteed to be a loser. I don't care how far it goes, you're not going to make money. You might break even if the world goes in your favor. Step 5, convert to a pool call spread. So once inside the 21-day, or if price spikes and the short leg's at risk, so I'm in the thing, I've ran 2 to 4 diagonals against it. So I'm inside the 3-week period. I have no more time to run diagonals, so I want a bull call spread to stop or put the brakes on my play here. And again, at the same expiration. So I go and say, so it locks in the remaining value, it limits further risk, right? And it smooths out your exit management at that point. So you can do that, and then you have the choice also, once you take a little bit of down call, if you still want to be able to, if you're still going down, you might want to exit the trade. You may want to just cover some of the profits in the sell call side if it's still coming against you, and roll that other call out one final time and rinse and repeat, do the same thing you just did. So it works out very well. It's very structured, it's very organized. On here, seeing it for the first time, as fast as I'm being, you may not get all this, but with me, you get one-on-one guidance on this. And with our room, we walk you through these steps because we do them live. So I'm doing my orders and my screen and my P&L is right up in front of you. So, and if you're in, the only thing difference is the risk. We're at the same strikes and the same money, or the same bids that we took for the price, but just the risk is different. So I walk you through because I'm doing my own anyway. So again, total risk remains capped at 2,500. Every short call offsets the theta and the IV crush. Diagonals reduce cost basis while keeping the upside open. And then vertical limits are added only to risk reward shifts. So we're putting the vertical in there, putting a bull call spread at the end because I get a much higher premium, once again, moving my risk down. If you do this correctly, you'll take a $2,500 risk. Instead of going $1,250 at a 50% pullback in your options, you should come out no more than 25%. That's not a bad gig. And this is only if it's going against you. If it goes for you, none of this applies. You're just going to ride that half lot to ever. Now, you can make more money with a half lot than you can a full lot. Why? Because we've all been there. When we see red, we can't wait to get green and sell, but we let the red go bigger, right? Well, the problem is that money speaks to us. We see green on our platform, our watch list, where we don't want to come back. Nothing worse to us other than the fact of selling something at the low and then watching it bounce and missing the upside. Nothing worse than watching the green become neutral, even, and then even red, right? It's a bad feeling, right? Just like you're giving money away. So, but one thing I found with half the risk in there, I just do management off the time frames on the daily 65-minute chart, keep it far out, and I chop into the trade about 30%. I'm chopping off a third of my position, and I'm working my way up, just like I'd be trading stocks at that point. But what I found is I will make twice as much if I don't enter a full position. So effectively, I'm at a full position because I don't let the money get emotional. Now, this doesn't happen much at a $100 risk, but when you get to $10,000 risk per trade, you're looking at $7,000 to $8,000 green on your screen, right? It can get emotional at that point in time. So you got to put yourself in the light where whatever you're doing now, can you handle that when you do scale up, in 2 years, 1 year, 5 years, whatever your game plan is, can you handle that? When I find that most people can't do later what they're doing now because the money scares them. They scare of losing it, giving back the green, or worse, letting the red go so long, and the second they see green or break even or small loss, they're selling out. So effectively, they have a bad Sharpe ratio, right? Average of higher losers divided by your winners, that's going to be like a 2 Sharpe or 0.02 Sharpe. Terrible. So you don't want to ever fall in that position. So there's many traps along the way. You need to know how to work your way out of these stocks. And most of our trades will be winners in this, or small losers. But in a worst case, with bad management, I could probably see 25% as a loss in here. And that's how I can trade bigger, knowing that I can't lose more than $500 on a $25 risk or $2,500 on a $10,000 risk. It really helps me to not be so strapped down, so analysis paralysis, right? If I see the plate, it makes sense. I don't want to think, well, I lost on the last one. I lost, I got $2,500. Should I lower my risk? Should I just not do it? Those are the things garbage that gets in the way that stops us from trading effectively. You have to have mechanics that fit you and where your weakness is. We all have them, and identify that. Know how you trade. What kind of person are you? How does that affect you to be red? How does it affect you to be green? Right? What does it feel like to go green then red, or just go red then a little green? how does that make you feel, right? Or when you exit out of a play, then it bounces on you here. So you've got to get in tune with who you are as a person. That's more on the psychological level. But once you do, this system can adapt to anybody out there. So it's just using the mechanics of a lot of different, I don't want to say complex options, but they are different. And it helps you be able to mitigate that loss at worst case. But when the upside's there, you're banking good profits. Ultimately creates high Sharpe ratio, and that's what it's all about. So the final thoughts on this, why this works. We're being reactive, not predictive. We predicted the patterns there, we're trying to follow the footprints of money, but in reality is if it's not going for us, it's going against us, right? Not only with price movement up or down, but also with theta decay. Scales in and adjust versus going all in. That's what I was talking about earlier. I love the idea, but when I'm trying to bid for a stock that never comes back, it usually always fills me in or around that area, even if it goes up first. So I'm knowing that it's better to try to catch it here because I don't know where it's going to come down to before it actually makes the turn, if it does make the turn, but I don't know where it's going to come to. So I want as good a price as I can get, but I don't want to risk unrealized gain, potentially, by trying to make 10 cents cheaper, right, on an option. So those are all the things you have to worry about. So when you actually have a way that you can get in more at the back, you have no problem going up to the midpoint, grabbing the entry, just going with it, and then you'll average in if it does fall against you. Finally, designed to stack income without giving up the trend. We're able to move this higher, trailing out in the larger time frames, but not giving up the trend of the stock. As long as I'm holding an 8-period moving average, I'm probably going to be trailing off there with some pivot somewhere in there, as far as I can possibly go. As long as it's moving up and I'm moving outside of my at the money call plus what I paid for the premium, so I don't have any theta working against me. The goal is, as you know, is you have a $5 premium and you paid, it's a $90 stock, then your break-even point's there. But if I was at 97, I don't have any theta. It's all positive because it's all working for me. So that all hinges on how you actually will manage the trade as well. And then finally, rolling. I won't go into a lot of this. Basically, if I do that bull call spread and I want to roll that option, I'll probably sell that short leg one last time, maybe roll out that option for one more time if I still believe in the trade. If it's a death trap, I'll let it go. For the most part, I'll roll it and I'll catch a slingshot back the other way and basically rinse and repeat. So I hope this helps. I'm the only one that I know of ever done it this way. It's something that I've just done little bits at the time. I'm sure everybody does a little bit of something, but I have this strategically set up to where there's no guesswork. I just simply follow the footprints. A plus B equals C, mash the button, hits that price, mash the button. At the end of the day, I make money or my risk is very small. Hope this helps. See you in the room.